Hi everyone, and thank you for joining us for today's webinar on the green bond market and climate bonds low carbon buildings criteria, a briefing for policymakers and building sector stakeholders. I'm Katie House, and here with me today are Monica Filkova and Corey Nesta to talk you through this webinar. Today, we're going to go over an overview of the green bond market, second-party verifications and the need for third-party standards and green definitions, the Climate Bonds Initiative and our taxonomy, an overview of standards, a high-level introduction to the buildings criteria, climate kick areas of focus, and alignment with climate kick impact framework. But before we begin, I'd like to go over some basic housekeeping. This webinar is scheduled for 1 hour and 30 minutes. The presentation will take 45 minutes, and then we'll open for questions. We'll have a dedicated Q&A session at the end of the presentation, and there will be plenty of time to ask your questions. You can submit questions at any point during the webinar by using the Q&A panel at the top right-hand corner in the webinar platform. All attendees of this webinar are muted, so questions can only be accepted written in the Q&A panel. This webinar is being recorded and will be made available to participants of the webinar and on our YouTube channel shortly after the presentation. Now, I'll hand over to Monica to kick us off.
Hello, everybody. I'd like to start off by talking a little bit about bonds and what are green bonds. Most people are familiar with loans that are provided by a bank to a company to fund its operations and assets. Bonds are very similar to loans in that respect. However, unlike loans, bonds are typically publicly listed, subject to securities regulations, and as a result of that, there are additional transparency and reporting requirements. Bonds are often used to provide financing and to refinance existing debt. In the context of infrastructure and buildings, they are used to provide large-scale funding, sometimes all in one go, sometimes in parts. What's interesting about bonds is that they're a very flexible instrument. They can be issued in a variety of currencies. They can be issued by a variety of institutions. And they're also available for investment by a variety of institutions. Some of the biggest investors for large-scale capital projects, such as buildings and infrastructure, are what are called institutional investors. These include pension funds and insurance companies who manage their own funds or have asset management mandates, in other words, have created investment funds. Typically, bonds are publicly listed, as I mentioned earlier, but it is also possible to have privately placed bonds. And in the green bond market, we have seen both types predominantly publicly listed, but we have also seen quite a few privately placed bonds. Bonds are usually rated. A rating helps investors identify the type of risk that is associated, or the level of risk, I should say, that is associated with a financing. So the higher the credit rating, AAA being the highest, the less perceived risk for the project. In the green bond market, we have seen a lot of issuance, for example, from development banks and government-related entities, which tend to be highly rated. As a result of that, green bonds, for example, tend to be investment grade, although we do have some examples that have a somewhat lower credit rating. Moving on to green bonds, what I'd like to point out is that the green label can be attached to a variety of debt instruments. The green label can be attached to loans, but where the market originated was around bonds. A lot of the bonds in the green bond space are what we call senior unsecured, so they're a general obligation of the issuer. But as this slide shows, we have seen a very wide variety of bond structures in the market. In terms of property financing, we have seen quite large deals from the covered bond market. We have also seen a lot of issuance from property companies through MTN programs, which is effectively a bond program which allows the issuer to come back to market multiple times. And we have also seen green bonds related to property in securitization. I'll come back to that a bit later. Overall, in the green bond market, we have seen a number of different uses of the money that is raised through the bond. We call that allocation of proceeds. This chart shows two pie charts, one for H1 2018 and one for 2017 as a way of comparison. Obviously, 2018 being just half of the year, it's an indicative comparison, but what I would like to point out is that renewable energy has always been a big part of the green bond market, and in fact, a lot of times when people say green bonds, the automatic association is that the bond finances solar and wind. That is not really the case. There are a lot of bonds that finance other assets, and buildings-related financing has been gaining ground. There are a variety of different issuers in the space. So we have seen property companies. The first property-related bond came in late 2013 from Sweden, to finance certified buildings. But we have seen a lot of issuance more recently in the form of covered bonds. So that includes German banks issuing these bonds, also Norwegian banks that finance residential properties. Just very briefly, a covered bond provides recourse to the asset as well as to the issuer. We've also seen a lot of issuance coming in the form of mortgage-backed securities. The mortgage-backed securities and covered bonds form part of what we call aggregation formats. Aggregation, so the bundling of smaller loans in a bigger deal, allows the market to scale up. So for example, covered bonds bundle a lot of small homeowner residential mortgages and create a structure that allows the financing bank to raise significant amounts of funding to continue promoting the use of financing in the green space, the financing of green buildings. As I already mentioned, we have seen quite a lot of securitization. Abbreviated here is ABS for asset-backed securities. This can take various different forms. The biggest issuer is a US government agency called Fannie Mae, but we've also seen issuance from the Netherlands, from Australia, from China, and some of it is secured on residential buildings, so RMBS and Fannie Mae Green MBS. Some of it is secured in commercial buildings, and some of it, PACE ABS, is focused on energy efficiency or improving properties to improve energy performance. Stepping back a little bit, the green bond market offers a number of benefits to issuers and investors. The labeling of bonds as green provides visibility. attracting investors from a wider set of countries or from wider backgrounds creates diversification. Some of these investors have specific mandates to invest in green assets, sometimes called ESG or SRI investments. Those investors in particular tend to be something we call sticky, in the sense that if they make an investment, they are making an investment because it meets their requirements under the mandate. They're less likely to sell the investment. That is actually good because it provides stability of funding and continuity of interest in the market and creates a demand for green bonds. As a result of increased engagement on the investor side, what issuers are experiencing in the green bond market is a lot of interest in their issues. So if they attract a lot of potential investors, that could potentially translate into better pricing. It also strengthens issuers' reputation and the visibility of any CSR or ESG efforts they might be engaged in. On the flip side, investors use green bonds to satisfy mandates, as I've already mentioned, but a lot of them actually invest in the green bonds simply because they make economic sense, which is a great position to be in. The investor pool for green bonds is about 50-50 split between dedicated investors and investors who like the bond. That in turn provides a lot of support to green bond issues in the market. One of the points that's often raised with respect to green bonds is the risk of greenwashing. So the market has developed certain mechanisms and tools that aim to ensure credibility. In principle, every investor is required to do their own due diligence and make sure that they're comfortable with the bond or any other asset for that matter that they're investing in. However, environmental due diligence may not be as straightforward. Some investors are quite small, may not have the capacity to do extensive research, which is where market tools come into play. They provide a framework for assessing aspects related to climate. And green bonds in particular identify assets that engage with the climate theme through through financing climate change mitigation or financing assets that are climate resilient, so effectively adaptation in the context of climate change. One of the other aspects that's quite important for the market and to ensure transparency and consistency in the market is that two sets of approaches have emerged. One is the development of principles, and by far the most followed ones are the green bond principles. Modeled on the green bond principles are green loan principles. As the name suggests, these are principles or guidelines that is recommended that issuers follow. And there are four principles essentially. The definition of eligibility criteria for use of proceeds, how one evaluates and selects assets, how one manages the proceeds so that they go to the selected assets which meet the eligibility criteria. And there is a recommendation to report on the use of proceeds or asset allocation to confirm to investors and the world at large that the money raised from green bonds is indeed applied to the right sort of asset. Climate Bonds Initiative has developed a taxonomy, a standard, and a set of criteria. Now, the difference between the standards approach and a principles approach is that within the standard, we're a lot more specific about the eligible assets, and the assets that are considered appropriate are reflected in the climate bonds taxonomy. Corey will be talking more about climate bonds taxonomy and sector criteria with respect to buildings later on. Off the basis of the green bond principles, our taxonomy, other taxonomies in existence, there are a number of other guidelines and standards that have become available. The ASEAN Green Bond Standard is one of them that's been developed by the ASEAN Capital Market. China has green bond catalogs that have been developed for the Chinese green bond market. The EU is developing a taxonomy that's related to climate. So the bottom line is that the industry may be approaching this from a different perspective in the case of each country and perhaps each institution, but the bottom line is that there is a concerted effort to ensure that green bonds are transparent. So if there's a promise to invest in a certain type of assets, then the money is indeed invested in those assets. And also that there is ongoing contact with the market in the form of reporting. From a climate bonds perspective, we have two levels of screening. So the first level of screening is our assessment if a bond that is labeled green or perhaps sustainability or perhaps climate bond does in fact meet the eligibility criteria in our taxonomy. And on the basis of that screening, we actually end up excluding some bonds that may be labeled green. Typically, that's because they are not aligned. So, for example, so-called clean coal, which is effectively improvements around fossil fuel power generation, is allowed under, for example, the Chinese Green Bond Catalog, whereas Climate Bonds Initiative excludes any form of fossil fuel power generation or improvements thereon, on the basis that whilst it may deliver some benefits, they are relatively small compared to what needs to be done to reach decarbonisation by 2050. Because we're focused on climate, we also exclude social projects. In principle, we support the SDG agenda, we support social projects, but for the purpose of our database, we exclude projects that have a significant allocation to social projects. So in summary, the way we operate within the Climate Bonds Initiative is by reference to a taxonomy. That taxonomy includes a number of sectors as listed here. So you've got energy with a number of subcategories, you've got transport with a number of subcategories, and so on. Within the building space, there are categories for residential, commercial, and for building upgrades. And the way that the taxonomy and our work is integrated is the taxonomy really drives the review of any bond that is issued in the market. And first and foremost, we look for alignment of assets to our taxonomy. In the buildings sector, that translates to us looking for green buildings.
Cool. So I can take it from here and give you guys a brief overview of the building's criteria. Like Monica said, we cover a range of assets that are non-building related. So if you have any of those in your portfolio, please feel free to email one of us, and we can direct you to the appropriate people. So like Monica said, this is a third-party standard as compared to a second-party certification or second-party review. A third party provides additional criteria and removes the issuer from the review process and ensures reliability in the certification, and it promotes investor confidence in the underlying assets. So to get into the building's criteria, how we started this process was with, and how we do all of the criteria development is to convene a group of what we call technical working group members, and they're experts in their field, in this case in the building sector, mostly from either scientific backgrounds, nonprofits, or the financial sector, with the goal of determining what a green building looks like. So what does a climate-aligned building need to be? And so our interpretation, our group's interpretation of that is to allow for the transition from where the sector is today to where it needs to be in 2050. So this involves transitioning building assets and portfolios to a net zero emissions operation by 2050. And so that's the sort of broad overarching goal of this criteria, and we have various ways that we assess assets along those lines. As Monica said, we cover commercial assets, residential assets, upgrades, which are under both of those, and then something we call public space. Commercial assets include everything from office, retail, hospitals, schools, and anything with a sort of a commercial side to it. Residential assets include single family and multifamily. This includes mixed use, so anything with 50% more, above 50% residential, as well as rentals and other sort of what we would say commercial assets, but they're for dwelling purposes. And then the public space is a bit of a catch-all, and that's for what we call what we're saying is the space in between. So if you have large campuses, neighborhoods, plazas, street lighting, anything where the particular building doesn't cover, that is captured under this public space category. The metric that we use to identify climate compatibility is a carbon-specific metric. It's a carbon intensity, so kilograms of CO2 per meter squared. And this carbon intensity metric decreases over time. So we benchmark the current market and how that's functioning, and and bring that down to zero carbon in 2050. So I'll go into more details about that later. But the goal of this process is to provide the financial market, a pathway to transition from where we are today to where we need to be. While everything underneath that pathway is included, so if there's go-getters that want to be zero carbon today, those are certified. We really want to mobilize the market, but also be stringent to the climate criteria. So what you'll see is that this metric is actually a lot steeper than what we're seeing in policy, other policy spaces and other certification schemes. So we're requiring a more rapid transition. So yeah, like I said, it's an emissions intensity metric. This is different than where traditionally what the market is used to. What we see is the market is very used to energy metrics, so kilograms of CO2 or BTUs per square foot. And our technical working group wanted to move away from that and onto an emissions metric. And the reason this is important is because when we look at the use of the energy use of a building, two buildings could have completely different climate impacts, but have the same energy demand. So we'll see, say in Poland, with a high carbon a carbon grid, so a lot of coal, or say Australia with a similar situation, those buildings are performing a lot higher or a lot lower, say, in terms of their climate compatibility. So they have high carbon emissions where they may have the same energy use compared to, say, a London building or a Paris building. So this emissions metric allows us to really target the climate component of the building. But what we're also seeing is that buildings are becoming more carbon intensive. They're becoming more energy intensive. So we're seeing more appliances, more computers, more efficient lighting, but still more energy-based lighting. And we have to be realistic that energy growth in the building space is going to grow, but that doesn't necessarily mean emissions need to grow as well. We can decouple those. So this is our strategy for doing that. The emissions metric covers Scope 1, Scope 2, and we're working on including Scope 3. So a bit of background, Scope 1 and Scope 2 are direct emissions associated with the buildings and indirect emissions associated from energy use, from offsite energy generation. And so those focus specifically on the operation side. We're seeing the sector move towards also incorporating Scope 3, so the embodied energy in building materials. And this is a really promising trajectory for the building space, because what we see is that say a wood building or something, building materials that are able to reduce their emissions or capture and store emissions through their materiality are able to have a really strong impact in the sector, and when it comes to climate aligning the sector with the climate. And then one last note on the emissions versus energy side of things. As I said, with say Poland and France, grid conditions really affect the metric responds to the grid conditions, and we'll go into more details about how that works. But say in high carbon grids, an emissions intensity metric promotes energy efficiency, where the biggest gains in emissions reductions can be achieved, where in low carbon grids, it incentivizes on-site fuel switching and electrification. So we see in Paris, or if we take another non-European example, in California, in order to maintain the green credentials, we're seeing that we're hoping that buildings that already achieve low carbon through either their grid or through their on-site energy, they start to switch to and focus on those remaining sources of emissions. So for Paris, for example, if the building is 90% electrified, coming from a nuclear energy, then that's going to have very low carbon emissions. But the remainder 10% is associated with on-site fuel combustion, so water heaters and boilers, et cetera. So the goal is to have this metric be dynamic to the grid conditions to promote the best case scenario globally, while being flexible in that way. So we have three options for certification, but this is really the bulk of it. This is the trajectory that I was talking about earlier. And it's a carbon intensity metric with the goal of achieving zero carbon by 2050. This is a generic example, but each trajectory is either country, depending on how much data we have, we can either do a country-specific trajectory or a city-specific trajectory. So that starting point at, what is it here, it's at 90. For example, it's at 45 in London. I believe it's at around 60 or 70 in Australia, and in Paris it's around 10. So that starting point really differs depending on which location you're in, how much electrification has happened in the building space or building sector, as well as your grid conditions. So if your grid is predominantly clean, then you're going to see a lot lower impact in those buildings. That doesn't necessarily mean that an efficient building or say a non-efficient building in France is the best, most efficient use the energy it's using, but it does mean it is climate compatible. So we really want to distinguish the difference between energy performance and emissions and climate performance. And just a brief overview, there will be a second webinar next Tuesday that will get into the details of the trajectory as well as any questions on the certification process. But just to briefly discuss the trajectory and how it works, a bond is issued in 2020 for 10 years. The midpoint of that bond is what the target for that bond needs to be. So it's a bit challenging to explain, but you can see in the illustration that over those 10 years, that bond has to, on average, meet that in this case, 65.19 kilograms of CO2 per meter squared. And that can be aggregated to full portfolios of buildings, or it can be an individual building issuance. We've had both with climate bonds. An example of this, most recently, was for a 500 million issuance through Barclays and with Carbon Trust as the verifier, and it leveraged the EPC, more particularly the environmental impact rating. So Europe has an EPC program that rates buildings on their energy use. United Kingdom, as well as a few other countries, have also implemented what's called an environmental impact rating, and that's a specific carbon, so CO2 emissions for that building, Scope 1 and Scope 2. So they also exclude embedded emissions in buildings. But that was very beneficial for us because that database has been made publicly available, and Barclays was able to easily identify their buildings along their climate performance, and then tag those ones in their portfolio that were green, as well as start to identify the ones that are low performers or that are very close that only need a few retrofits to be included. So they can start moving financing, such as with green mortgages, towards those assets that aren't aligned and help build the market and mobilize the market that way, as well as reward buildings that have already gone above and beyond when it comes to where the market is today and where they are. So more details on that can be found on this link, and happy to discuss that in further detail later. As I said, we really need a lot of data we need transparent data from the market and from governments to be able to do this benchmarking. In the meantime, as the EPC database and post-issuance reporting of buildings goes more mainstream, we've come up with what we're calling the Interpolation Method, and that looks at the climate credentials of a particular city, and using data sets in other locations, we can interpolate and say a building in this area, in theory, would use this amount of energy, and knowing the energy and emissions, and the on-site and off-site energy split, we can then benchmark the emissions intensity. It's a bit of a complex process, and I'll keep it high level for here. But as you can see in this diagram, all the green dots are the places that we can certify. Yellow, we would like to have more data and need to ground truth it against a local data set. And then red, we're working on expanding into via gathering data sets in those areas. And what you notice is that it's really based off climate, so the Mediterranean and sort of temperate areas we're really sure about, and as you get further north or further south, our certainty falls a bit lower. So that's why we're limited at our current time. And so we've had an example of this in Germany, and are currently working with few issuers in Germany to benchmark against this interpolated process, and hope to have those out fairly soon. I'm happy to provide more information for those of you in Germany working in the sector. And then part of this process has been to develop materials for the market to not only provide the standard, but to also provide the background and rationale for the standard, as well as guidance documents to help issuers and verifiers, as well as investors, understand how the sector, how the criteria work. So what you'll see is the first document aligning buildings with the climate compatible 2050. That's really our background document for this work that we've done. It goes into depth about the processes and principles behind the criteria, how we got to the emissions intensity figure versus energy, what the key issues are in the space today, and what are some of our solutions we see needing to happen to be able to mobilize the market. So I would really recommend anyone interested in this space to read that document. And then the other ones are examples of our various country-specific guidance documents. Those are really helpful if you're an issuer and you're looking to understand what the criteria is for, say, London or, say, Germany or Berlin. And they show the proxy method versus trajectory method and really provide a step-by-step approach for how to use the criteria. And so all of this work, and particularly continued work in Europe, has been funded through Climate Kick. And Climate Kick is a really interesting program that helps mobilize the European market. It's by the European Institute of Innovation and Technology, or the EIT, and it's a knowledge center. It works to accelerate the transition to a zero carbon economy. Sort of high level, their mission is to convene networks of experts, leverage grants smartly and efficiently, develop people and capacity, and catalyze innovation. We've used this grant funding to continue our development of location-specific low-carbon trajectories for the building sector through convening technical working group to sort of iron out any issues, as well as providing standards for the green bond market to increase, to provide the credentials. And then a bit more about Climate Kick. They have 4 areas of focus. We are specifically working in the decision metrics and finance area. So that's urban, they do urban, area of focus of urban transition, sustainable product systems, decision metrics and finance, sustainable land use. And then the key impacts for these are mainstream climate to the financial markets, which we see ourselves doing, democratizing climate risk information. And so when an issuer does issue a bond, that the use of proceeds is made publicly available on our website, and all of our standards our criteria are free to use. So we really try to promote and mobilize the market in this way by giving the market information. And then the last one is to help foster bankable green assets in cities. And what we're seeing is a lot of the movement in the green bond space is directly in cities, in decarbonizing cities. So in decarbonizing commercial infrastructure is really where we're seeing the most issuances, and then residential after that. And then the last piece about Climate Kick is they have a list of impact goals. These are the ones that we see we're really working to develop and to meet. So you're welcome to read through these if you have some time, and definitely encourage you to see the Climate Kick website and their mission there. And just finally, this work has helped fund commercial coverage in Paris, so in France, in Germany, in London. We're also developing in the Nordics, Czech Republic, and we'll have a few more going forward. We have an issuer and some data in Spain. So it is really taking off. I'm working with some policymakers to see how we can move, we can bring this approach to the policy world. And then, this a little bit about certifications to date, and then how we're engaging with the market, which I mentioned before. And then if you have any questions, feel free to message them on the chat, and then we can go through those one by one and hopefully answer any outstanding questions.
Thanks, Corey and Monica. So just as a reminder to everyone, that you can submit your questions via the Q&A box that's down in the right-hand corner of your screen. We have had a few questions already coming in, but we can take more, so keep them coming in. So Corey and Monica, this question is probably a bit more aimed to Corey, but maybe Monica, you'd like to comment from the kind of green bond angle. Can land for a proposed green building be considered eligible as a green asset?
So you're saying, say, a property, a piece of land, investment in a particular piece of land without the building. For the buildings criteria, there wouldn't be criteria to assess against because we don't benchmark the performance of the land, but we do have land use criteria that you can use to review that. As far as the value of the land, it's the full value of the property, including the land, that is used in the certification. So that would be included in that way, but do you have any addition to add to that?
Yeah, so from a green bond perspective, so the distinction we're making here is green bonds versus certified bonds, and perhaps we should explain slightly why we have that distinction. So certification criteria, probably picked up on this in going through the presentation with Corey, but certification criteria are quite specific in their requirements that the asset needs to be on a trajectory to decarbonize by 2050. In the green bond space, we are actually somewhat more lenient. In part, that's a reflection of where, where the economy is and where assets are, insofar as we need to transition, but not everybody is quite that advanced. And one of the main things we want to achieve is get as many people on board and working towards transitioning as possible in the early stages of the market. So when we look at green bonds, for example, a building, we would accept a building that has a building certification of, let's say, LEED Silver, whereas if the issuer that's behind that building wanted a building certification, there would be a few more metrics to supply so we can confirm that the building is indeed on the emissions trajectory to full decarbonisation. So coming back to the actual question, in terms of assessing land, if it's purely land, we could assess, and we have seen bonds that relate to parks and preserving natural habitat. And we have seen a bond that is linked to a sustainable rubber plantation, afforestation, and the creation of small croplands. We have also seen quite a few forestry-related bond issues, including a covered bond secured on forest land. We haven't yet come across a scenario where it's just the land with the intention to build a property. I think, to be honest, we might struggle a bit unless it's very clear exactly what is going to be built on the land. Perhaps one of the things that I forgot to mention with respect to bonds is, in general, bonds are used to finance income-producing assets because the way bonds work is you raise money upfront from a number of investors. Over the life of the bond, the investors get interest, and by the end of the bond term, the investors need to get their capital back. So that requirement to create an income stream is linked to the asset. So generally in the bond space, we see assets and projects that generate income, hence residential mortgage, the pools of residential mortgage loans where the income is the interest each individual homeowner pays on its mortgage, or a commercial building where you've got tenants paying leases. So I'm not sure that the asset itself would be quite appropriate for bond financing, except perhaps in the scope of project finance, which is something we've seen in infrastructure. That's a long-dated project, less used for buildings per se, but it might be used in the public space. So we have seen a number of cases where issuers have come to market to upgrade or add to public sector space, such as hospitals, for example. There was a bond raised by the Canton of Geneva for hospital improvements. Having a project like that for an investment program that's related to building space is conceivable. I'm just saying we haven't seen it just yet.
Thanks, Monica and Corey. Another question: what is the average size for retrofit projects? And sort of what size would you expect to see retrofit projects coming through? Is that something you can take?
Yeah, I mean, what we're seeing is about 500 million is the average certified issuance, and that includes retrofits as well as, but that's an aggregation. So that's an issuer coming to us with residential, commercial, and retrofit projects on both sides, and aggregating those into one issuance. We also have individual buildings that have been certified using the upgrades or retrofit approach, and that is much smaller, obviously. And I think we've gone up. It ranges, but I would say on average is around 500.
Another thing I would like to point out to this point, I guess, is that we don't really expect every person who has, or every institution that has a project, to access the market directly. Earlier I was talking about aggregation. So, for example, the PACE program in the US is a property assessment program that provides very small amounts of lending in bond terms to individual homeowners and small businesses to retrofit their buildings, perhaps by adding solar panels, perhaps by making other improvements to upgrade the building. And what happens with these smaller loans is they get aggregated by the loan provider to create a bond. In the Netherlands, ABN AMRO did a deal a few years back. That was the first one that I saw of that nature, where they specifically identified residential mortgages as an asset, and what they were intending to do is use the funding to provide additional lending to their mortgage borrowers to allow them to upgrade their residential properties. If the upgrades are relatively small, there are structures that have been used by banks and other lending institutions to aggregate those smaller loans. But also in the actually also for certified bonds, whilst a lot of them have come from larger institutions, they have been smaller ones. I think it was again the Netherlands, one of the first upgrade certification was sub 100 million. Off the top of my head, I'm tempted to say 80. But it wasn't the 500 average size that Corey was quoting. So there is really a range. And in some markets more than others, smaller deals may be more acceptable.
Next question. Sorry. Are there plans to develop a trajectory for India or Indian cities?
Yeah, we get this question a lot. In emerging economies, our biggest weakness when it comes to the criteria, but we're also seeing a lot of interest because it does allow for more due diligence on those bond issuances, and so there's a big demand for that there. The thing that we're seeing, is particularly in India, is the range or the spread of emissions intensity. The spread of emissions intensity in India is so broad. You have LEED buildings that are high performing in European standards, but from an emissions standpoint are higher emissions performing than, say, a no energy based building or a residential building in India. So we're seeing concerns there, and we're looking at ways to develop that, particularly for, say, an HVAC-based building versus a non-HVAC-based building. So actively cooled or actively heated and cooled versus passively heated and cooled, and creating two standards there. Ideally, we would like to move towards that passively run building. That those are the highest performers. So we do want to incentivize that, and right now we do cover that. But yeah, in terms of where the market's headed and what criteria we have, we're in the process of developing that. In addition to the sort of trajectory side of things, we have another approach, which is our proxy criteria. So where we don't have the data to create a trajectory, you can either do the upgrades route, which is 30 to 50%, depending on the term of the bond, or you can use one of the proxies. And we have some international proxies, including LEED, gold, gold and platinum, so gold and above, plus the ASHRAE 90.1 energy standard. So they have to meet both of those to be qualified. And then the second proxy is the EDGE criteria. So particularly with India and China, we're seeing the EDGE tool be leveraged. And the reason we certify EDGE is because it is one of the only international standards that directly requires emissions calculations and reporting that as part of the certification process. So we really want to promote that process, and particularly within these markets that are fastly developing.
Thanks, Corey.
Yep.
A question on the building sort of certifications. What's the equivalent level of Green Star certification with LEED Gold?
I don't think we have Green Star certified. From what I understand, it's levels 1 through 8, and it's predominantly used in Australia, New Zealand, and South Africa. We are looking into it. I think it would be a 6 and above, but we haven't done that assessment thoroughly yet. So we've just started working with the Green Building Council, as well as some issuers around possibly developing that as a proxy in the interim. But if you are in Australia, if that question came from someone from Australia, we do have building code proxies for the Australian market for residential, as well as decarbonisation trajectories using NABERS data or neighbors data.
Thank you. Does the buildings criteria include embedded emissions from materials?
It does not include that, so that would be scope 3, and we are working on the World Green Building Council, as well as LEED, BREEAM, and some others are working on methods for calculating that. What we're seeing sort of happen is that existing buildings are moving towards being assessed on their operational performance, so not going back and calculating their embedded emissions. And then new buildings, the policy world and certification world is moving towards providing standards for new construction around requirements for embedded energy, as well as other Scope 3 based emissions.
Okay, thanks, Corey. I have one more question that's come through at the moment, so I just want to give everyone a reminder quickly. If you've got any more questions, please put them in that box. Otherwise, we'll take this last question and then we'll finish a bit ahead of scheduled time. So yeah, get those questions in if you want. If you've got any more and you want to keep the Q&A session going. The question I've got for now: how is market integrity ensured in the green bond market? So it's a bit a broader question than just buildings.
Okay, perhaps I'll start. The integrity is ensured through a number of different mechanisms. So certification is in the form that we've been talking about it certainly comes into play, but certification actually is just one of many ways that issuers can demonstrate their transparency and alignment to the precepts of the green bond principles or the climate bond taxonomy. So first and foremost, we have the general concept that a lot of this issuance is coming in bond format, and earlier I mentioned that almost all, certainly not all, but a very large part of bonds are publicly listed. That comes with disclosure requirements, so issuers are essentially required to tell all existing potential investors where the money is going. And one of the requirements that is getting increased focus is the disclosure around what would be considered green eligible assets. And over time, the prospectus, which is the offering document for the bond, we've seen the prospectuses are increasingly including more and more language around what is considered green and how assets would be selected and how the proceeds would be managed. One of the other aspects we've observed is that increasingly, as corporates and former financial institutions, companies, as well as local governments have come to market, they have followed the green bond principle and developed frameworks which describe what would be eligible assets, how they would select them, how they would then make sure that the money goes into the intended investment. And in connection with these frameworks, we have actually seen an increasing use of external reviews. Now, external reviews can take the form of second-party opinions. That would be a company that has environmental expertise looking through the framework and effectively confirming that the identified assets in process are aligned to the green bond principles. It could be a form of assurance, as is provided by companies such as EY, Deloitte, and others. Increasingly, we are seeing the use of green bond ratings, so green bond assessments. A number of rating agencies, such as S&P and Moody's globally, but also rating agencies in Malaysia, in Japan, in China, have created an assessment process that looks at how the assets are defined in terms of eligibility and selected. And all of this is generally provided pre-issuance. So at the time the bond comes out, and investors are expected to invest in it, that information is available. But under the green bond principles, and generally as a good practice, issuers also commit to ongoing reporting. So that's something we call post-issuance reporting. Last year, Climate Bonds Initiative did a study of a stock-taking exercise of issuers and whether or not they were meeting that commitment. In other words, if they were producing reports that confirmed the allocation of bond proceeds to the assets. This year, we are repeating that exercise, but we're also starting to look on whether or not issuers are providing impact reporting. And if they are, what exactly do impact reports say? So taken all together, all of this reporting and disclosure makes the market more accountable, which is, to my mind, the definition of integrity. And just by the fact that an increasing number of issuers are using external reviews and are committing to reporting, we think the market is sort of self-regulating in the sense that issuers understand it is in their best interest to be open to the market and provide as much disclosure to provide support for any further issues they might want to do further down the line. So it's a self-reinforcing mechanism and something we view very positively. Just to put things into context, in 2017, about 92% of green bond issuance for the year had the benefit of an external review, which when you think about it is quite impressive, because it essentially means that practically everybody had somebody else come in and take a look at what they were selecting and what they were promising to report. Certification, the way we do it, the Climate Bonds Initiative obviously sets a higher standard. There's less people going through the certification route, but the existence of certification and its adoption is another bright spot in the green bond market, because it allows issuers to highlight their alignment to that 1.5 degree world and the Paris Agreement.
Yeah, and those issuers that are new to the market that don't have, say, second party reporting standard can easily leverage the criteria. So we're seeing a lot of issuers in-house the third-party standard as a second-party process, which we also see as a good sign.
Thank you. We have we have one more. No, sorry, we have no more. There's no more questions come through at this stage. So I think that means that we can bring this to a close a little bit early than we'd scheduled, but we had put in quite a long chunk for Q&A. So thank you to Corey and Monica for walking us through that content today, and thanks to everyone for joining the webinar. As we said before, this has been recorded and we will put this up on YouTube shortly, and we will also be sending around the PowerPoint slides to everyone who turned up for the webinar. So thanks again, and we hope that you found it an interesting topic.
Thank you.
Thank you.